Hello and welcome back to another trading concepts video. Today we'll be diving into external range and internal range liquidity, and we'll see how we derive a narrative and a bias from these certain concepts. So let's dive right into it. So what really is a narrative? Context on the higher time frame is a must. Without the understanding of higher time frame, you are just more or less gambling. It can help you identify points of interest and understand why price moves towards a specific level. So, for a clearer understanding of where the market is more likely to draw to, we focus on external and internal range liquidity. The only arrays we consider while looking for external and internal range liquidity are old highs and lows and fair value gaps and imbalances inside that range. The most significant liquidity pools are beneath previous lows and above prior highs and at points of inefficiency in price delivery. The important question is, if a low is being formed, if a high or a low is being formed, is it being formed to engineer liquidity or to take liquidity? Which, if more simply put, says that if a weak high is being created or a strong high is being created while we look at the market structure and the price delivery. So the question is that what really is ERL and IRL? The external range liquidity and the internal range liquidity. So ERL is basically the resting liquidity found at the extremities, the highs and the lows of the range being dealt, where the internal range liquidity IRL is the open fair value gaps and liquidity pools inside the range which propels price towards the higher time frame bias targets. As we can see here, we have two simple examples, illustrations of what price really does and how it really moves. So price more or less moves in two particular ways. Either it draws towards old highs or lows, or it rebalances an imbalance. More simply put, that price either moves from IRL to ERL or ERL to IRL. As we can see here, price has swept the lows, previously existing lows, inside a fair value gap, which you can call an internal range liquidity pool, and then propelled towards the external range liquidity. And in this example, price has moved from external range liquidity towards internal range liquidity, where it has taken the range highs and then moved into your internal range liquidity, which can be a fair value gap or imbalance left from the reaction from the range highs. To put it even more simply, think of it as IRL works as fuel to propel the price towards ERL. And once the ERL is taken, price either continues in the same direction or reverses the existing trend, targeting another IRL or ERL. What does that really mean? So think of IRL, the internal range liquidity, as fuel. Suppose price is here and this is your fair value gaps and imbalances inside the range you are dealing with. Price takes your internal range liquidity, maintains your market structure and the order flow, and the internal range liquidity acts as fuel for your price, propelling it towards the range highs. And once the range highs are taken, the external range liquidity has been swept. Price does one of two things. Either it continues in the direction of the existing trend, or it gives a reversal and changes the entire trend. Now we'll look at some examples, understand it more carefully, and see how we can actually use it to build a narrative for ourselves. Looking at this Euro USD chart on the daily time frame, more or less, I personally use external range liquidity and internal range liquidity concepts on the higher time frames only to create a narrative, to understand the draw of liquidity for the price, and basically then jump into lower time frame lower time frames to actually formulate ideas on the existing narrative and bias that I have already. Looking at this, we have a bearish weekly fair value gap, and this low can be taken as our external range liquidity. Price has swept these highs inside a bearish fair value gap, which is our internal range liquidity, in the direction of our previously existing order flow and market structure, and then price has broken down simultaneously from that point. To make it even more, internal range and external range liquidity basically cannot be directly used to trade. It is used, I'll say it again very clearly, that I use it personally for having a narrative and a bias. So when I see price rejecting these highs as well as this internal range liquidity, I'll use these concepts to actually see price break down on the lower time frame. And on the lower time frame, like on the hourly or on the 4 hour, I'll use it to formulate my own entries. As I can see here, price is delivered towards the downside and left a bearish daily fair value gap, which I can say that it is an internal range liquidity, and I have external range liquidity in terms of my range lows here. So price again swept highs inside this range liquidity and then continued towards chasing my external range liquidity. This is a prime example of internal range to external range liquidity. Price, as I said, draws in only two fashions: internal to external and from external to internal. As we can see here, this is the example from internal to external. Again, on the bearish side, where we are looking at the daily chart of US 100 CFD, the NAS CFD, and price has again swept these lows, tapped into our daily fair value gap, reacted from it really well, and then pushed on to draw towards our external range liquidity. We already have previously existing range highs. Price took out our internal range liquidity, coinciding with our market structure and our order flow, and internal range liquidity acted as fuel to propel it towards the external range liquidity. We can form ideas here on the hourly or on the 4 hour to take entries, but this particular setup is just used to give us a narrative. And here, in between this price action, we can form our trades on the lower time frames to have a clearer entry aligning with our narrative and bias. Looking at one more example, this is the weekly chart of BTC USDT. Um, Again, internal range to external range liquidity example. Uh, on the weekly, we have a weekly fair value gap left open from rapid price delivery. My bad. Again, we have another example of internal to external range liquidity, where we are looking at the BTC USDT chart on the weekly time frame, where we have an open bullish fair value gap due to rapid price delivery, and price has tapped into it simultaneously, and here the price has swept these pre-existing lows, taken out the lows, reacted very well off of it, and price has propelled towards the external range liquidity. Again, a very simple way to understand it as internal range liquidity acts as fuel to propel price towards your external range liquidity. So that's all for this particular video on external range and internal range liquidity. Again, we'll be soon making more videos about understanding higher time frame narratives and biases. Soon I'll be making more videos on dealing range, your higher time frame arrays, stop hunts, buy or sell programs, seasonal tendencies. But until then, let time do the heavy lifting. Keep on doing your own work. Keep on putting in your hours and efforts and just wait for the results. Be patient. Until then, stay safe. Happy trading. Bye.